Okay, well, thank you for joining us for the October version of the Ag Economic Dialogues. We have a pretty full lineup today. Matt Dearson is going to talk to us about risk management for calves and cattle. Laura Edwards is going to join us with a climate forecast for wintertime coming up, and then I'm going to cover some feed costs and expenses coming up for the winter and springtime, getting those calves to market. So with that and no further ado, I will turn it over to Dr. Dearson and he can share his screen and take over from here.
All right, good morning. I've got a PowerPoint today and I'll try to incorporate a couple of things, and feel free at any time to stop and ask questions as we go along. So I'm working from my office on campus. The other morning, this was a view I had to kind of lean out over the window to get a fall shot of the campanile. It's hard to resist taking a shot of the campanile when you get the chance. So that's what it did look like before the wind picked up on campus the other day. Today we're going to talk a little bit about livestock risk management. I wanted to highlight that there was a recent publication put out by the Economic Research Service talking about farm use of futures options and marketing contracts. There's not much in there related to livestock, but it did show a general overview of the results from the 2016 ARM survey. There was a little bit higher percentage use of options when you deal with cattle versus futures, and less marketing contracts compared to, say, the percentage for corn and soybeans. So encourage you to just check that out. What I highlight today, talk a little bit about I think the waning slaughter issues that we saw from the earlier part of the year. And there's really some signals happening in the slaughter data and cattle on feed data that points ahead to what we might be looking at when we get into 2021. We'll take a look at backgrounding and some of the risk associated with that. I'm going to highlight some of the impact or the changes again to livestock risk protection, not repeating the changes, the fact that the subsidy level has increased. And then if there's a minute or so, we might talk about PRF. Big picture with prices. I'm going to get myself a laser pointer here. Heather, let me know if this is too annoying. You should see a laser pointer on the screen. I just want to highlight some things. I've been grabbing some charts from the Chicago Mercantile Exchange as of late because it's what I have my students use in the trading class and for some of their exercises and things. So it's just sort of the one source we're using at this time. We can see here we've got live cattle, two things overlaid. We've got the December contract, and I overlaid the June 2021 contract in this pumpkin colored line chart here. So we can see that the contract highs were put in right at the beginning of 2020, and then we had the impact on price for these deferred months from the COVID-19 supply disruptions. And then as of late, prices have been relatively stable in the grand scheme of things. So maybe that market has settled down a little bit was sort of my take home message from that. Beef production year to date. You can see here we've got weekly beef production levels. So this is pounds produced, and it had been running ahead of year ago levels. And then the COVID disruptions, the major disruptions here as slaughter really slowed down. But year to date, slaughter is expected, or beef production is expected to be right at the level observed last year. The latest WASDE had it within a few 100,000 pounds of year ago levels. So production's back on track, or the pace is back on track. And there's some underlying things going on behind the scenes driving this a little bit. So got a couple of other related charts. The pace of slaughter is really on the females side of the equation as it pertains to beef. Beef heifer slaughter has been running at or above year ago levels. So that was a liquidation phase last year, and we're seeing that continue in that live cattle market right now. Throughout the year, there was this sharp pattern across all classes when the COVID was most had the biggest impact at the time, but heifer slaughter before and after has really remained high and higher than the 5-year average. So again, on the beef side, but it means probably some continued liquidation or not adding cattle or heifers rather to the beef cow herd. Same pattern shows up with beef cow slaughter. The one small category that's having a minor effect, but it's still relevant, is calf slaughter. Animals being prepared for the veal market, that pretty much has just really dried up during the last year or so, somewhat impacted in addition by the pandemic as well. Dressed weights have sort of fought the seasonal decline that would have happened here because cattle had to be delayed and weights added, but that weight increase has sort of slowed now. As of course, as you get to the time of year, it's hard to add additional pounds, but that is another contributing factor. Cattle on feed had a sharp disruption in placements in March and April, so that gave this sharp decline, counter-seasonal decline in the cattle on feed numbers, and those have come back, and now we're taking some of the cattle that would have been placed there, and they're still remaining on feed, but I don't think it's a major deal because the cattle on feed for more than 90 days and more than 120 days is kind of back to normal, or the typical seasonal pattern we'd see. The other thing we've got is cattle placed weighing more than 700 pounds. So less than 700 pounds makes up a smaller portion, and it didn't have quite the absolute number impact that the heavier feeders had. So big decline in placements in March and April and the above 700 pound category. So those animals aren't going away. Some of them were placed here and here and here and here. So we're still, you could say, still sort of moving through a backlog of some of the heavier animals, and that shows up in some of the price data too, in terms of what animals are going through sale barns. On the price side of things, so here is the November feeder cattle futures price. So it started the year pretty much put in its contract highs at 156 there back in early January. It also was affected by the overall COVID disruptions, and then started to come back. So I'm going to zoom in on this price series a little bit here. I'm going to concentrate on the 6-month window right here. So zooming in, price from July started to really increase nicely, peaking there in mid-August before declining. What's going on, or what drove that? Well, with live cattle futures remaining fairly constant or stable through this time period, it's no surprise that what was going on was, again, overlaid in the I got pumpkins on the brain there, Heather. I've got another pumpkin colored line chart. Overlay the corn price here. So as corn futures, new crop December corn futures declined from July to August, that was giving a corresponding increase in feeder cattle values. And then as it shifted gears and corn started its uptrend here, supply shocks, if you would, unexpected increase in disappearance of corn, culminating in the September 1 grain stocks report. A lot of old crop corn disappeared, and the only category that was thrown in the latest WASDE, they put it in feed and residual. So they either weren't sure, or they said it must have been fed, and it could very well have been fed to a great extent to cattle and hogs that were held back or held onto for a longer period of time, slightly adding to the weights, and perhaps seeing a slight decrease in feed efficiency during that time, meaning the livestock sector kind of bailed out the crop sector there for a while. As corns continue to increase because of some new crop supply problems, the derecho storm, for example, that went through Iowa, and I think maybe a little bit of corn seller and soybean seller holding on to, or having that ability to hold on to the crop a little bit, not being in as big of a hurry to send it down the line. That's increased the price there, and the corresponding drop has happened in the November feeder cattle futures. How do you bring those two things together, the offsetting of a futures price and then the impact of corn? Well, I kind of look at that a little bit for the a joint impact, and I could show it cleanly. I think I've got enough time. I'm going to show just a couple of ways to do this using the overlaying some things in the CME charts. So I'm going to shift and share a screen here. So I'm just going to overlay my CME screen. Heather, can we see this?
So now I have your CME webpage.
Yes, that's what we're
Yes.
after. So I'm just going to go to markets, go to agriculture, and just quickly find livestock, and I'm going to grab feeder cattle. So here's what I think is happening with the future value of calves. So if you think about a typical calf sold in South Dakota, a 5-weight sold in November, it's probably going to be based somewhat off of the futures price for feeder cattle for March. So I'm going to grab that March feeder cattle contract. You see you've got a pretty big discount between feeder cattle today and that nearby October at 138. You get out to March, it's down to 130. But the same pattern has held. And I'm going to just launch this in a pop-up. Kind of fun. So here's a giant screen, and we don't need to see 2 years of feeder cattle. So I'm just going to zoom in. So here's about the last 6 months of feeder cattle futures for March. So this is March 21. And then here's what I have my typical students do in class is, let's just take this feeder cattle, and let's say that price per hundredweight is multiplied by 7.5 hundredweight. So that gets you a value of a 750 weight. And that gives us prices here of $974 a head, for example. And then off of that, if you think about interactions between the price of feeder cattle and the price of corn, if we take December corn futures, and normally I'd multiply this by 15 bushels and then divide by dollars per hundredweight. So I'm going to cheat a little bit here for the sake of time and just multiply that price of corn in cents per bushel times 0.15. So that's going to be the cost per head to feed 15 bushels of corn to a calf. And that's going to show up in just a second. And then I'm also going to take a typical price for a ton of hay and subtract that off the value of the feeder animal. So from one way to look at this is per head, that $974 value is now reduced to only being an $814 value. So that would be, come November, you'd look at the cost of feed and you'd look at the futures price available, and you'd say, oh, a calf is only going to be worth $814. And then you can play around one more time and divide that calf value in November, convert it to a 550 or a 5.5 hundredweight price, and it spits out a rough calf value of $150 per hundredweight. And then I like to come up here too and manipulate this thing, and it's tough to talk about a daily price for a calf. So let's convert it to a weekly price, just rescale a little bit. So take home from July to August, the net impact on a calf, feeders went up a little bit, and corn started its rally, but as corn continued, it's having this negative impact on calf values, dropping the value nationwide from say 170 down to 150. And then you got to tack on an expected basis for South Dakota calves. So all that kind of culminates. I'm going to minimize this and go back to my PowerPoint slide, culminates in this. So here it is, that pattern. So that combination of things is weighing on the calf price over the last month and a half, 2 months here now. And that has shown up as well if we look at the weekly stocker price, so the cash price in South Dakota for 500 to 600 pound steer calves sold at AMS reported barns. They were about up to $180 a hundredweight in mid-August, and since then they've slid down to last week, settling around the 160 area. So that pattern there, these are cash prices, and the prior chart would be where would those prices be come November. So I'm talking about this prior chart here is saying what are calves big picture going to be worth in November. So we've got to get down to, or got to move ahead in time, because you have some idea of what's happened on the future side of things, to get to this point. Since that's kind of where calves are at, what if you were to hold on to those calves and feed them for a while in a backgrounding situation? So for that, you want to think about holding, or looking at the price risk from November, when a calf would normally be sold in the cash market, through March. So here is the futures price change of the March feeder cattle futures price from the middle of November until the middle of March, or I'm using the average during November and the average during March. So same contract, March feeder cattle futures held from November until March. So what we've got down here is last year, heading into 2020, the futures price was around 140 or 145 or 150, something like that. And it dropped almost $20 a hundredweight from its level in November until the height of the coronavirus impacts on price at that time, down about $20 a hundredweight. That was not quite a record because the absolute price change was even larger, going from November of 2014 into March of 2015. So these 1, 2, 3, 4, 5, 6 of the last 10 years, the futures price has fallen from its level observed in November when you could have sold a calf until March. So had you retained ownership and not done any price protection, you'd have seen the value of the animal fall. In this case, every $10 move is a $75 per head hit to a producer's bottom line retaining ownership. So this would have been a $75 and this would have been a $150 per head impact simply because the futures price changed. Nothing to do with feed efficiency or any other issues, strictly the price impact. That leads to pretty strong consideration for the fact that there's some risk in this market. There's risk this time of year for holding on to calves in a backgrounding situation unprotected. The average of these price changes, just these price declines over the last 10 years would have averaged about $7 a hundredweight. Over the last 20 years, it's only about $4 a hundredweight. But if you think about a seller of an option in the situation, they would be wanting, they would have had losses. They would have had this $20 loss and this $19 loss that they would have had to pay out if someone had purchased an option from them. So they're looking at that, and that would explain why at today's prices and rolling ahead to a November purchase time, I was calculating out an option today would probably cost about $5 a hundredweight, so less than what's been paid out, but a little bit more than what you'd expect a little bit more than what you would expect looking at the long run costs. So the market's not oblivious to this fluctuation that's present in that market. And what can a producer do? Producer can look at buying put options perhaps if there's a profitable calf price. I'm not too keen on the price level seen right now with that March futures being as low as it is. But perhaps a put option protection, and another one would be livestock risk protection, which we've talked about in earlier dialogues. In mid-September, the RMA announced that they were increasing the price subsidy again for this current fiscal year. Fiscal year for livestock insurance starts July 1. It's a July 1 to June 30th fiscal year. They increased the subsidy and made it retroactive to the beginning of the fiscal year. It now ranges from 35 to 55% of the premium. So an option that may have cost an option that would cost $5 a hundredweight, now perhaps 50% or 40% of that can be picked up through the insurance product, livestock risk protection. Prior to 2020, that subsidy was only 13%. It's a nice product, cover any number of head, and the premiums aren't payable now. That was another change at the beginning of this fiscal year, not payable until the end of coverage. So I want to highlight or show what that subsidy looks like. That subsidy used to be 13%, and they take coverage levels like it's crop insurance. A little confusing because no one talks about receiving 77% of the feeder cattle index value, but that's what those percentages are. What percent of the futures price or what percent of the cash settlement price are you looking at on a feeder? Those subsidies were raised on these nearbys. 92% coverage would be a $10 move in the market right now. So that feeder cattle futures sitting at 130. You're looking at a strike price in that 120 area with these subsidy levels. It had been raised to 30%. Now it's 40%. So a $10 out of the money option right now is probably going to cost around $2.50, give or take. So 40% of the subsidy takes that cost down to about a little over $1, $1.50 a hundredweight. So really makes a difference in my mind. I think that's a huge price difference or a huge cost decrease, making more coverage available for a given dollar, if you want to think about it that way as well. And once you get to these further lower coverage levels, it really starts to pick up a greater and greater portion of the cost. At the same time, looking at options, the further out of the money you go, the less protection you want to buy using options outright, not using LRP, using options outright, the cost diminishes greatly as you go to further and further out of the money with put options. So I looked too, and as of this morning, there were already some open interest in March 21 contracts. There are some open interest for $80, $94, and $104 strike price options. So the cost to get a $20 out of the money option is less than $1, a hundredweight, very low prices. So these subsidies don't matter as much because the cost of the underlying coverage goes very close to zero. So you should be able to, if someone wanted to, they could get a lot of, or a fair amount of protect against a big wreck in price type of coverage for not a lot of money, with or without the subsidy at these levels. So I think LRP's sweet spot is probably in these higher levels. If a good strike price or floor price was presenting itself, having to only pay 60 cents on the dollar for that would be attractive from a risk management perspective. Number of feeder cattle insured, to show the impact of that subsidy from 19 to 20 when they raised the subsidy level, it did not have a volume impact. There was not a lot of volume of LRP sold across the country last year compared to earlier years. South Dakota did keep its share of that market steady. But here in 2021, this is just from July 1st to October 14th or 15th, already more head are insured nationwide and in South Dakota year to date than in all of last year. So, you know, if you think about that being 3-4 months, that would put it on a pace to have coverage back up here in that 250,000 head level across from a nationwide perspective. So it is having an impact. Of course, everybody's kind of very conscious of the fact that there were very, very high volatility levels last spring. The implied volatility on that, I think on the August contract got up to 40% on feeder cattle. Currently, that volatility is down around 18% for the March 21 contract. So LRP increase in the subsidy is resulting in some increased demand for protection, and same thing's happening on the live cattle side of things. The volatility here recently is down around 20% for these December, February, April contracts. I threw this up here. This is I recycled a chart from a May, I believe, dialogue, and at that time, the June and August contracts were still on the board. That volatility had been up 50-60%. So what would that do to an at the money put option right now? Taking at the money that's say $5 and doubling or taking the volatility up to 30% means you got a $10 option all of a sudden. So these volatility changes, it's good to have this volatility lower, making the cost to lay off the risk much better than before. Another related product is livestock gross margin. It doesn't have the increase in the subsidy associated with it, but I wanted to show the expected and actual margin variation. So this would be a feeding margin to take a 750-pound steer and only feed it to 1,250 pounds. It's unrealistic, but the pattern is the important thing. The difference between the expected margin for retaining ownership further on or just buying some yearlings now and holding it for 6 months. This is a rolling 6-month expected margin after purchasing corn. And the ration on paper in this example is 50 bushels of corn. So I buy a feeder steer, I feed it 50 bushels of corn, and I sell a finished steer weighing 1,250 pounds 6 months from now. What does that look like? From that expected margin, you've got to cover yardage and any other feed costs. So any hay, roughage, whatnot that would be needed as well. So that's not profit per head. It's an expected margin after paying for the calf or the steer and paying for corn. So that's been averaging around 150. Overlaid is the actual margin. What does things settle out at? And there's huge swings relative to expected. So when you actually get to settlement time, pay for the corn, pay for the feeder animal and sell the final animal, you can see that there's large negative times that happen. And again, this is without those additional feed costs, and huge windfall periods as well. Just making it kind of a volatile situation. And this chart's a little out of date. I haven't updated the last couple of months, but just wanted to show that expected line in there because so I'm going to switch gears and fast forward again and talk about a cattle crush, which is what this is. Whoops, forgot one other slide in here. That's going to happen. I mentioned the premium subsidy because back in for cattle to have finished in the around October of this year, had you bought that 6 months earlier, or what happened during the COVID run up, the premiums shot through the roof as the volatility in the market increased as well. So LGM was not an end run around the high volatility that was present in the markets. But I wanted to take that same idea and look forward today. And again, I did some manipulations. Here's the end result. If we look at what would happen if you took June up here, we can see the details. You take June live cattle, multiply by 12.5 hundredweight, subtract off a 750 weight feeder cattle, feeder steer purchased in F, of course, F being January. I actually have on my whiteboard on the other end of my office, I have the months written on my whiteboard. So F, G, H, J, K, M, N, Q, U, V, X, Z, which is also a useful eye chart. But the different months just labeled up there, so I can quickly kind of use it as a cheat sheet. So take that finished animal, take off a feeder in January, and then take off 50 bushels of corn in cents per bushel. So you just take the contract price quoted in cents per bushel times 0.5, and that spits out this per head feeding margin or cattle crush for June. And that cattle crush, the class has been watching that a little bit too. The cattle crush has been increasing a little bit. And as of late, it's done this. It's jumped above. I just overlaid the $150 per headline in there. So again, this is not profit. This is maybe more of a break-even line here. And when it gets above that break-even line, you're perhaps starting to see some signals from the market. Hey, here's a time to perhaps lock in a price, lock in some, look at some protection, because if price continues to be in this range here, these are perhaps more profitable levels for the foreseeable future. So I just said this is an area let's watch this area. And should something like this cattle crush continue to look good, perhaps you look ahead and you say, I'm going to background my calves now. Next January, let's put them on full feed or change the ration or continue to retain ownership because you continue to see this profitable level, and you can come in here at that time. So perhaps it is at the end of this period, you're coming in here. If you still see that margin exists, perhaps a signal at that time to take some action, retain ownership with some price protection, maybe something like LGM at the time, or LRP or put options and whatnot on the cattle crush available. Any questions on that cattle stuff? There's something flashing down there. I don't know what a chat question. Heather, is there something I need to deal with? You're muted.
Sorry, I just wanted to let you know it was 10:33.
Yeah, I'm kind of trying to watch that. Wrapping up. So there's feeder cattle risk, there's risk backgrounding. The cattle crush is actually looking okay or somewhat attractive. There's volatility in the market, and there's a reduced number of heifers, giving us some ideas about next year's calf profitability might be a little better than this year. And one other piece, and I called it a whisper in my outline, there is one other type of price or one other type of insurance that's on sale right now. It's not a sale, but it's the sign up time period for pasture rangeland forage rainfall index insurance. Many folks around South Dakota have heard me sort of talk about this from time to time. It's as frustrating as ever to pick insurance intervals of rainfall when you're trying to protect against the price of forage going up. So, but given the dry conditions in the western half of the state, just maybe don't dismiss this. It's got a November 15 deadline to go in and make any adjustments. Here's a snapshot of the United States. So since this product was introduced nationwide coverage, there's never been a year where the producer premium in a given year wasn't exceeded by the amount producers receive back in indemnities. So every year, farmers, ranchers have received more from the product than they paid in, received more than they paid in, received more than they paid in, received more than they paid in. At the state level, that's not the case, because a very wet year like 2019 didn't result in many payouts. That's with hindsight. So just a heads up, and hope to have a write-up on that in the next week or so, prior to or to still give producers some time to give that some consideration before that purchase deadline, November 15th. But given the dry conditions, I expect to see a lot of demand for that in the western part of the United States. Certainly would be something to consider across South Dakota as well, given its performance through time. Conservative amounts of purchasing coverage tends to pay off over time as well. With that, that's all I really had. If you've got some questions, I'd entertain live questions now, or email is always nice. I've got my office phone there yet, so there's questions that way. Please do reach out and ask them. And anything quick for the screen?
If anybody has a question, you can either type them into the chat area, or if you would like to unmute your microphone and ask the question, we would entertain those as we go.
And a closing.
Matt is going to be leaving the stage here in a little bit. He has to go teach his class. So use that email address or send me a note if you have something that comes up later, and I will get that forwarded on to him if it comes to you later. So.
And for the, if I could conclude, Heather, two things I'm watching rather closely, and this hopefully leads right into, hopefully Laura will talk about it a little bit, especially out west, the western United States. They've been talking about the drought monitor and the worsening drought conditions in the western half of the United States pretty much since midsummer. So it was starting to be an issue, and more of an issue. That could be behind some of the movement of beef cows to slaughter and some of the heifers to slaughter. So I think coming up, next week's Cattle on Feed report is going to give a snapshot of heifers on feed. So that's going to be an important indicator, important aspect to watch. Gives us some real idea of how much liquidation is happening or continue to happen, and where prices might be headed heading into 21. Thanks.
Okay. Thank you very much. I don't have any questions in the chat that came to me, so we'll turn it over to Laura. If you do have questions as it goes through, type them in and we'll get them to the right person, and we'll go from there. All right, Laura, you're up.
All right, great. Thanks, Heather. I'm gonna launch right into it because I have a commitment at the end of the hour as well that I need to get to. And I can't see the chat while I'm presenting. So Heather, just give me a holler if I miss a question as we go along here. So let's see here, dive right into it. It's been dry out there. I think we've seen that all the way across the state, not just the west, the east too. This picture is actually from southwestern Minnesota, but not too far outside our state line, where this was a fire not combine started, but by a cigarette on the side of the road that set this whole field on fire and caused some substantial damage there too, not just harvest challenges. So let's see here. And I know there's been quite a few combine fires out on the east side, harvest related fires. And I know it's really, really a tough situation for some folks. Just look at the growing season overall, nothing really extreme on the temperature side. We had a lot of ups and downs for sure, flips and flops back and forth, but overall kind of middle of the road temperature wise, and nothing really to mention there. Out west you see the areas that were much warmer than average. This is for April through September. Looking at the precipitation side, again, we're in the bottom third driest out of 126 years statewide. Again, you see to our west and west southwest, really much drier than average for the 6-month period there for the growing season so far. But nothing as extreme. I think the biggest challenge was, a big flip from last year to this year. Up here where I'm in Brown County, one of the highest prevent plant acre counties to start the season, and now it's really, really dried out in a hurry. So I think what's more drastic is the quick change, but a lot of that soil moisture that we had last year kind of in reserve carried us through and I think helped make our yield this year, at least on the cropping side. Looking at soil moisture right here, this is our poker chip map, we call it, from our Mesonet, our weather stations. So you can see each of the sensors down to 40 inches deep. Yellows, oranges are drier, greens and blues are wetter. Really a big change again from last year this time. I think one of the concerns right now is that we're not recovering much on soil moisture. We've had a very dry period the last few weeks to a month or so. This is generally our recharge period for soil moisture, because kind of what locks in when the soils freeze is what's available in the spring for spring planting and the cropping side. Also looking at pasture, range, forage, you know, what we carry in soil moisture in the fall really has an impact on how we start spring grasses. And so I'm a little bit concerned here that we're carrying over some dry conditions to start. And as we get later in the fall, our chances of recovering that moisture and recharging that profile kind of diminish each week we go into the season. Matt mentioned the drought monitor, a little bit of change out in the western part of the state. About a third of the west there now is in D1 or moderate drought. That's a change from last week. So I encourage you to keep an eye on this if you haven't already. Livestock forage program payments are tied to this map. If you guys have producers out there, both east and west, but really out in the west, I've heard really substantial impacts out there. The challenge, though, is that the climate data is not showing as severe a drought as the impacts are. And I think there's a few complicating factors this year. One was grasshoppers. They made a huge run at eating a lot of the grasses and vegetation out there. Second was a late frost in the spring, late freeze in the spring that set back some grasses as well. And then just the dry conditions. But with intermittent rains, that in the climate sense doesn't make it look so bad, unfortunately. So I think the challenge here is that the impacts are outweighing what some of the climate data are showing, and I recognize that, but it's a challenge with the drought monitor to justify a worse category when we don't have the data to back it up. Just looking at the last 8 weeks, last 2 months, basically the drought monitor, this is what areas that have changed, and so anything yellow orange has gotten worse. Gray has stayed the same. Greens have gotten better. So you can see really from the Dakotas westward, really more worsening than anything. And again, this is what we're going into the fall with. Certainly we, like I said, our soil moisture, our carryover from last year really carried us through the early spring season. But at one point, you know, at some point you just can't keep up with the dry conditions as well. So you see that worsening condition here. I believe now it's the highest percentage nationwide of drought since September of 2013. So nationwide, we're seeing quite a big swing in drought, though, you know, similar to about 7 years ago. Missouri River, not worried about flooding basically for this season. Things are slightly above average for the year so far. As far as the runoff goes in the whole upper basin, that's above Sioux City, everything above Sioux City, but you see the red line there, that's indicating their total storage in all the reservoirs on the main stem river, way below the green line, which was last year this time, even below 2011. That's a black line at this time. So we're above average, but not as concerning for flooding for sure. And again, that no big surprise there. You can see on the right, that's a old sunken ship, steamboat in the river, in the Missouri River there by between Vermilion and Yankton that someone I know saw over the weekend. And that just tells you how low the river's gotten out that way. We can start to see those things uncovering again with the low river. Frost freeze, not much to mention here. This is 28-degree hard frost. Probably doesn't have much impact now on corn and soybeans, as a lot of it is harvested and or dried, ready to harvest. This would be more concerning if we had moist grain in the field, but we don't. So again, these are the areas that have seen a hard freeze, 28 degrees. So it's really probably more a thing for those of you who have gardens and horticulture concerns, but probably not too much unusual now at this point. Looking ahead towards the climate outlooks, looking ahead towards winter, yesterday NOAA released their winter outlook, and La Nina is one of the big stories. Although up here, kind of a mixed bag. Not historically, we're looking at a moderate to strong event. So this is looking at temperatures in the winter season, December, January, February, those 3 months put together. What have historical La Nina temperatures been for all those events since 1950? And you can see I kind of drew these boxes around the moderate to strong events. It's about 85% likelihood of La Nina this winter, so pretty good chances. But you can see historically La Nina has favored colder than average temperatures, but not always. So if you look at average, yeah, we lean on the colder side for La Nina, and that's often the story I tell. But there are exceptions kind of to every rule. So keep that in mind, but certainly leaning towards the colder side more often than not in the winter. This is looking at winter, December, January, February. Precipitation, similar story historically, back to all those events since 1950 that are classified moderate to strong. I highlighted here in the boxes. Up here in the Dakotas, doesn't tell us a whole lot historically. Maybe lean slightly wetter, that'd be green. Brown, they're drier. But the other thing that we'll see in the outlooks coming up here in their official kind of outlook is that our long-term trend is towards wetter winters. Last 20 years or so, we've seen a lot of really snowy winters. So overlay that over this La Nina pattern and might get a hint at what we'll see in the winter, December through February. Looking out the next week, not much to say here. It's going to be pretty dry. The white is actually almost zero. This is the next 7-day rainfall or precipitation. Really pretty dry conditions, but we'll be cold. So starting Sunday, we're going to start to see some cool temperatures, a very strong high pressure over the northern plains. Really going to affect more North Dakota, Montana, but about a week from now or middle of next week, we're going to start to see that filter down into South Dakota, some of our coldest temperatures of the season. So keep an eye out for that. Certainly favoring cold, and this is what you see here 8 to 10 days from now, 1 to 2 weeks from now. Really high likelihood of colder than average in the north central states. Precipitation, kind of uncertain right now as the pattern is changing. We might see some wetness middle of next week, but looks like it'll be pretty brief and move through the area pretty quickly. So November, the next month ahead of us here. Not a lot to say in the Northwest here. South Dakota's kind of teetering on the area. It's favored to be warmer in the south. This is the left map. Warmer to the south and equal chances, warmer, cooler, or near average to the north. So kind of on that line. On the right, you see precipitation, certainly to our south, odds leaning towards drier than average conditions in November. So this is not the next couple weeks, but the month of November. And again, this will be updated on Halloween on last day of month, but this is our first look at November, what they're showing for us. I'm going to skip ahead to December through February, just in the interest of time. This is kind of the heart of the La Nina season. We see more of that La Nina influence here in January, February, really the latter part of the winter. And that's what you see really making a a strong influence here, and the temperature on the left-hand side in particular, with us leaning colder than average and up into the Pacific Northwest, south leaning warmer than average. And what happens is the jet stream comes really far down south, so we get more of that cold Canadian air in the winter season. On the right, though, they are leaning towards wetter than average, at least the northern part of the state and up into Montana, North Dakota, and then over the Great Lakes, which is pretty common during La Nina winters. But certainly, I think they're leaning on our long-term trend, plus some other kind of atmosphere patterns that they're seeing. So a chance of seeing maybe a little more snow than average here, December through February. As far as drought goes, you know, I think we typically see pretty limited recovery in the winter season. We might see some small changes here and there in the drought monitor, but more often than not, a lot of change happens faster in the spring or in that snowmelt season as things thaw out. So, you know, not to say we can't change things on the drought monitor in the winter, but it's usually pretty limited, despite this outlook that shows wetter than average, more likely. So as we get into spring, La Nina has less of an influence and kind of wanes quickly in that March-April timeframe. So it's really pretty short-lived here over the winter season. I think that's what I'm going to end with there, Heather. And I could take questions or people can reach out to me later. Thank you.
Okay, thanks a lot, Laura. I appreciate it. I don't have any questions typed in. I have a lot going through my head right now going, okay, planning for this is going to involve what now? So, well, thank you for your time. I greatly appreciate you joining us for today's dialogue session conversation. So Laura mentioned she had another commitment at 11. So as we see her disappear from the participant list, we do thank you for what you provided for us today. So with that, I'm going to wrap up with about 4 minutes of really quick. I want to show you how to get to one of the feed value tools that we have. Matt talked a lot about changes in prices. Laura talked about a lot of changes in climates. So that's really going to greatly affect a lot of the feed that we have available coming up. If you want to do some extrapolation in your head on hay availability and what that does to hay prices back and forth that way. So I want you to be thinking about ways that you can make the most bang for your buck with your feed dollars and utilizing supplements to the best of your availability and opportunities. So with that, I'm going to share my screen quick and get to our SDSU Extension webpage. And I would like to just talk to you about the calculator that we have available on there. So if you go to agriculture and click the Ag Business tab and scroll down, there's the September Ag Dialogues. We've got some featured resources that show up here. And then in this yellow box is all of our decision aid tools that we've created and put together for you. If you click on that feed nutrient calculator, it's going to open up a spreadsheet for you where you can input a lot of different values for your operation. And I must have accidentally shut the one that I wanted to share with you today. So excuse me for 1 second while I try to find it and reopen it. Thought I had this already, my apologies. So what the feed value calculator does is it gives you the opportunity to compare traditional energy and protein supplements of corn and soybeans to other feeds that might be available in your area in an effort to reduce your ration costs and expenses. And that's where you can really make some of those changes in your feed. Maybe you put up some really good high quality alfalfa this year and you're running stock cows. They might not need that high quality protein alfalfa. You could maybe sell some of it and take that money and purchase other feed stuff supplements that are more economical for your operation and really stretch out the corn stalk bales that you're able to put up this fall, since we do have that dry weather conditions and lots of bales going up right now. So some of the things that you need to look at when you're talking about this calculator is you need to know what the freight charge for a per loaded mile is going to be for you working with your trucker. We need to know how many tons are in that load. And as you look down this list, you can see that I just put 26 tons. I haven't done the full math for you. And then however many miles it is to get that product home. How many miles are you going to be charged? And you can see, so I picked a farm and I just kind of put in some of those prices as the nearness to me, and the feed availability really starts to affect that adjusted price per ton basis. So now we have a delivered feed cost price that we can compare to back and forth. The calculator, everything in yellow is where you can input numbers into. So if you go down clear to the bottom in this area here, rows 29 through 34, you can put other feeds in there to compare. Maybe you do have that high quality alfalfa and you want to use that as your protein source. We can compare that to some other sources that would be available in your area to get your most bang for your buck. And then we go to step 2 for the results section. This is where you can look at the price of corn as an energy supplement is costing you $128 per ton. So if you can get beet pulp or soybean hulls or other energy sources for these prices listed here, you're getting the same value for the energy that you would be getting for corn. And then the same thing with the protein supplements that are listed. If you were comparing against soybean meal, given the distance that you're being hauled, the expense of the feed, and how much it takes to get it to your place versus the per ton weight rate or the per bushel rate, here's the prices that you could pay for those feedstuffs to get the same amount of energy. So that way you can tell if that protein, so that you can tell if that protein source is really bringing a value to your operation, or you should be or could be feeding something else. So we just wanted to make you aware of that tool. I had some slides with different changes in prices back and forth for different feedstuffs as we went through, but as we're nearing the 11 o'clock hour, I'm going to probably cease with those slides. I do want to let you know that there is a weekly report on the hay, feed, and seed report that comes out, so you can see what South Dakota prices for different quality of hay is being sold for across the state. And there is a pretty big variety in those prices right now. So knowing what kind of hay you're buying or selling, you could be leaving a lot of money on the table if you've got some high quality, either alfalfa or grass hay that you were able to put up. So maybe investing in that feed test before you put a price on it is really valuable this year, especially. So with that, I would entertain any last questions that you may have, or if there's anything that we can do to help you, please send me an email, let me know, and we'll get you the information as soon as we possibly can. We'll do this again in November, so be watching your email for your November invites. And with that, I tell you thank you, good luck, and I hope harvest wraps up well for you at your operations. Thank you.